$3.4 trillion. It's a number so massive, it almost loses its meaning, right? But it actually represents one of the most concrete, hard-hitting financial realities of our time. And we're not talking about corporate debt here. It's not the federal deficit either. No, this $3.4 trillion represents the hidden, unfunded liabilities lurking inside just the state and local public pension systems in the US alone. It's literally a multi-trillion-dollar gap between what's been promised to millions of workers and what's actually sitting in the vault. For decades, the whole global pension system has basically run on absolute trust. You know the deal. You work hard, you pay into the system, and in return, there's a secure, predictable income waiting for you when you retire. But as global markets shift, as populations age, and as accounting practices finally get a closer look, we have to ask a pretty uncomfortable question. When you finally reach that finish line, is the money you've been promised actually going to be there? Okay, let's dive into this. We're calling it the shadow deficit. It's this systemic fragility that impacts almost everyone, yet it somehow stays totally out of sight. To really understand it, we need to look past these surface-level assurances. We're going to examine the global finance mechanics and those hidden business systems that are quietly but completely reshaping retirement. Part 1. The surface. The global pension squeeze. To wrap our heads around the sheer scale of this threat, we have to start at the surface, with everyday people. Let's look at the UK, for example. According to a recent retirement report from Scottish Widows, 12.2 million Britons, which is a staggering 31% of all UK adults, are currently at risk of pension poverty. That means millions of people are literally on track to not have enough money to cover their basic, everyday needs in retirement. It's a massive number. And one of the biggest drivers of this squeeze is something you feel every single time you hit the grocery store. Yeah, we have to talk about inflation. In financial circles, it's known as the silent thief, and for good reason. See, when you're living on a fixed pension, your paycheck stays exactly the same, but the world around you just keeps getting more expensive. Over a typical 20-year retirement, a seemingly harmless 3% annual inflation rate can basically slice the purchasing power of your pension right in half. It quietly drains the real value of that money, making things like healthcare, energy bills, and just daily living exponentially harder to afford. Part 2. Just below the surface. The demographic squeeze. Now, if we drop just below that surface layer of inflation, we run into an unavoidable macro trend making everything worse: global demographics. According to the World Economic Forum, we're officially entering the era of the super-aging society. That's defined as a nation where over 20% of the population is over 65 years old. And look, countries like Japan, Italy, and Germany, they've already crossed that line. The math here is incredibly unforgiving. The traditional pension model completely relies on having a large base of active workers paying in to support a smaller group of retirees. But with life expectancies rising and birth rates plummeting, that pyramid is turning completely upside down. The WEF is actively warning that this demographic shift is going to trigger systemic crises that will really start to bite over the next 10 years. Part 3. The deep underwater, hidden debt and deficits. But to truly grasp this multi-trillion-dollar fragility, we have to look at the systemic accounting illusions that are keeping the global system afloat, especially in places like the US. See, when governments report on the health of their pension funds, they use a metric called the stated net pension liability. The problem? That number is based on highly optimistic assumptions about how their stock market investments will perform. Financial economists at the Hoover Institution point out a pretty fatal flaw here. A pension promise is guaranteed debt. Even if the stock market completely crashes, the government still legally owes that money to the retiree. Because of that, basic financial principles say these liabilities absolutely must be measured using the yields of risk-free government bonds. And when you measure them that way, getting what's called the market value unfunded liability, the gap between those two numbers is just breathtaking. Now, what's really interesting about this slide is how vivid this accounting illusion actually is. Look at the data for major municipal districts. The gray bars show the official stated net pension liability, but the blue bars, that represents the true market value unfunded liability. Take a look at the city of Chicago. Their stated liability is already huge, but when you price it accurately against market risk, that true blue bar extends way, way further out. By basically assuming rosy stock market returns, cities and states are effectively masking massive financial shortfalls and keeping them right off their primary balance sheets. To put this into a bit of perspective, the Hoover Institution found that pension plans often use an expected return rate of around 7.6%. Let's translate that into plain English. Expecting a 7.6% compounding return means that state and city governments are banking on the money they invest today doubling every 9.5 years. with absolute certainty. Financial legends, including Warren Buffett, have explicitly warned against doing this. He's noted that you simply cannot assume time is just going to bail out pension systems from poor stock market returns. Part 4. The desperate gamble for yield.
And that brings us to a really terrifying market consequence. After 15 years of historically low interest rates, pension funds woke up and realized the math simply wasn't adding up. So, to chase those high returns they desperately needed, they started shifting capital away from safe liquid assets and poured it into illiquid alternative assets. We're talking private equity, hedge funds, real estate, and private credit. This creates a really dangerous cycle. First, the funds invest in assets that don't trade daily on a public exchange. Because there's no public market price, the value of those assets is estimated using non-transparent models provided by, you guessed it, the asset managers themselves. And finally, governments calculate how much taxpayer money needs to be contributed based on these estimated and potentially very inflated guesses.
And these gambles carry very real, very modern risks. Take this example highlighted by World Finance. The Ontario Teachers' Pension Plan, which is one of Canada's largest and most respected funds, was forced to write down $95 million it had invested in the cryptocurrency exchange FTX, right after the platform spectacularly collapsed. Now, sure, that was a fraction of their total portfolio, but it perfectly grounds this abstract idea of risky alternatives into a very stark reality. When pension funds chase yield in opaque, volatile spaces, real capital gets destroyed.
Part 5. The threat of valuation risk. And this brilliantly illustrates the massive blind spot this reliance on alternative assets introduces. Let's compare the risk profiles here. On the right, financial experts recommend everyday individuals save about 15% of their salary for a comfortable retirement. That's a disciplined, conservative approach. But on the left, we see that today, a stunning 27.9% of total institutional pension fund assets are locked up in valuation risk alternative investments. Nearly 1/3 of the $5 trillion in assets reported by U.S. public pension funds in 2023 is based on non-transparent valuation models. To give you some context, back in 2001, that exposure was just 8%. The systemic risk has literally more than tripled. The consequences of this structural deficit aren't just theoretical, they are already bleeding into the real economy. Because past assumptions were way too optimistic and investments haven't always covered the spread, governments are having to aggressively hike their payments just to cover the gap. According to the Equitable Institute, unfunded liability payments by employers have skyrocketed by an unbelievable 1,388% since 2001. Think about that. That is taxpayer money, money meant for roads, schools, and civic services, being diverted to plug a purely financial hole. So, we are rapidly approaching a looming reckoning. The economic data is pretty clear at this point. Average assumed rates of return are slowly being forced down to a slightly more realistic 6.88%, but hitting that still requires massive cash injections. Today, over 2/3 of government employer pension costs go entirely toward paying off old unfunded liabilities, not to funding future benefits for current workers. As the lag in private market reporting finally catches up, widespread markdowns of those alternative asset values are pretty much imminent, and employer contribution rates, they've now passed 30% of payroll on average. The mathematical strain on the whole system is absolutely reaching a breaking point. We've explored the surface crisis of inflation, the demographic undertow of a super-aging society, and the deep hidden accounting deficits driving this desperate gamble for yield. The $3.4 trillion shadow deficit isn't some distant, future problem. It is actively consuming civic budgets right now. Which leaves us with the ultimate question. As cities face mounting pressure, and as retirees face a higher cost of living, who actually pays when the illusion finally breaks? Will it be the taxpayer through higher levies, the public sector worker through slashed benefits, or the broader economy through a systemic financial contagion? The math is waiting for an answer.